What's up, everybody, and welcome back to the channel. You guys know I like to keep a close eye on anything that could shake up the market. And right now, that's got to be President Trump's tariff proposals. We're talking a possible 10% to 20% tariff on imports from pretty much everywhere and up to 60% on Chinese goods. It's crazy. I've got this CNBC article here from January 20th, 2025 that lays out some of the companies and products that are most at risk. It's called Here Are the Products and Companies Most at Risk from Trump's Tariff Plans. And honestly, it's got my head spinning with all the potential portfolio plays. So first things first, right? Let's acknowledge this isn't our first rodeo with tariffs. Remember the trade war a few years back? Yeah, this kind of feels like deja vu. But here's the thing. The economic landscape is totally different now. Inflation is already eating into everyone's budgets.
Yeah.
And these tariffs, oh man, they could seriously pour gasoline on that fire. And that brings us to the big question. How will this impact your investments? Well, let's dive into the nitty-gritty, starting with China. Now, China is basically the world's factory, right? They make a huge chunk of the stuff we use every day. Electronics, clothes, furniture, you name it. If those tariffs hit, those extra costs are probably going to trickle down to us, the consumers. Think about it. Almost 30% of the furniture we buy here in the U.S. comes from China. A 60% tariff. That could easily add hundreds of dollars to the price of a new couch. Then there's the toy industry. Get this. A whopping 80% of toys sold in the U.S. are made in China. That means your kid's new Barbie doll could jump up in price by 56%. Ouch. And don't even get me started on shoes. Over a third of our footwear imports come from China. And remember, we import almost all the footwear we buy. So get ready for those sneaker prices to go through the roof. So how does all this translate to your investment strategy? Well, companies like Mattel, they make Barbie and ELF Beauty, a big name in cosmetics. Both have significant exposure to China. They're already talking about raising prices, but will consumers really be okay with those increases? That's the big question. All right, let's shift gears and head south of the border to Mexico. This is another key trading partner, especially for the auto industry and those everyday things we can't live without. U.S. automakers rely heavily on Mexican manufacturing. These tariffs could really mess things up, potentially disrupting production and making cars way more expensive. And I mean significantly. Some analysts are predicting that companies like General Motors, Ford, and Stellantis could see their profits take a major hit. But it's not just cars. Get ready to pay more for your Corona and Modelo too. Constellation Brands, the companies that makes those beers, imports all of it from Mexico. Those tariffs could make your after-work beer a luxury item. And avocado lovers, get ready for some sticker shock. Almost 90% of the avocados we eat here in the U.S. come from Mexico. So yeah, get ready to pay more for that guacamole. Now, from an investor standpoint, this is where things get interesting. Constellation Brands is already making Wall Street nervous. Will they pass the cost on to us beer drinkers, or will their profits suffer? And what about Chipotle? Their guac is already pretty pricey. Will they actually raise prices even more? These are some tough choices, folks. And the companies that can figure it out will be the ones that come out on top. All right, so let's head north to Canada now. They're more than just our, friendly neighbors who love their hockey and maple syrup. Canada is a big source of imports too, from cars to raw materials. And those tariffs, well, they could definitely have an impact on their economy. And ours too. Their auto manufacturing industry, especially in Ontario, plays a huge role in the U.S. market. So if these tariffs actually happen, we could see job losses, on both sides of the border. But here's something you might not expect: French fries. Yep. You heard that right. Canada is a major exporter of frozen potatoes, with McCain Foods being the biggest player there. So that next order of fries at your favorite burger place, yeah, it might cost you a little more. And if you're into that high-end winter wear, get ready to pay more for that too. Canada Goose, famous for their expensive parkas, manufactures something like 70% of their products in Canada. So yeah, luxury winter wear could get even more luxurious. Now here's where things get interesting for us investors. This whole tariff thing could actually be good for U.S.-based French fry suppliers, like Lamb Weston. If McCain Foods has to raise prices because of the tariffs, Lamb Weston could come in and take a bigger share of the market, see? It's all about finding those opportunities, even in unexpected places. Okay, so we've covered a lot talking about China, Mexico, and Canada. The big question is, how does all this affect your portfolio? Here's the deal. Tariffs usually mean higher prices, right? And higher prices can really hurt consumer spending and company profits. So be careful with companies that rely heavily on imports from these countries. For example, a retail giant like Target, ticker symbol TGT, imports a lot of their stuff from China. They're probably going to struggle if those tariffs hit. Another one to watch is Keurig Dr. Pepper, ticker symbol KDP. They get a lot of their coffee beans from Mexico, so their costs could definitely go up. And for those of you who like to invest in the beer market, Molson Coors Beverage Company, ticker symbol TAP, imports a good amount of their beer from Canada. They could be in for some tough times if these tariffs happen.
But remember, every cloud has a silver lining, right? This whole tariff thing could actually create some great opportunities for investors who know what they're doing. You just got to know where to look. Think about it. If those frozen French fries from Canada get more expensive, people might start looking for other options. And that's where a company like Lamb Weston could do really well. Or what if the cost of furniture from China goes way up? Maybe US-based furniture makers will see a jump in demand. The key takeaway here is that tariffs create both risks and opportunities. Companies that depend on imports a lot might see their profits shrink and their selling prices go down. But at the same time, businesses that can offer alternatives to those imports could find themselves in a really good spot. It's kind of like chess, you know? You have to think ahead and try to predict what your opponent will do, and then position your pieces the right way. Okay, so we've talked about the risks and the potential rewards of this whole tariff thing. Now let's get down to the really important stuff and play a little game of who wins and who loses.
On the loser side, we've got those companies that rely a lot on imports from China, Mexico, and Canada. We already mentioned a few, like Target Keurig, Dr. Pepper, and Molson Coors. But let's add a few more names to that list. Keep an eye on Whirlpool Corporation, ticker symbol WHR. They make a lot of their appliances in Mexico, so those tariffs could really hurt their profits. Another one is Canada Goose, ticker symbol GUSS. Remember those expensive parkas? Well, since most of their stuff is made in Canada, their costs could go up a lot. Now let's switch gears and talk about the potential winners, the companies that could actually benefit from these tariffs. Remember how we said Lamb Weston could benefit from higher French fry prices if those imports from Canada get hit with tariffs? Well, that's a perfect example of a company that could do really well in this situation. Another interesting one is U.S. Steel Corporation, ticker symbol X. If tariffs make imported steel more expensive, domestic steel producers like U.S. Steel could become a lot more competitive.
And here's one that might surprise you. Hanes Brands Inc., ticker symbol HBI. They're a big apparel manufacturer, and if those clothing imports from China get hit with tariffs, Hanes Brands with their U.S. manufacturing could be a big winner. Now let's be real for a second. This is all just speculation and nothing's guaranteed in the stock market. But by understanding how these tariffs could affect things, you can start to find companies that are in a good position to deal with these changes, and maybe even come out ahead. And that's what it's all about, right? Staying ahead of the game, knowing what's coming, and making smart decisions to grow your money. So there you have it, a deep dive into how these proposed tariffs could shake things up in the market. We covered a lot today, but here's the main takeaway. Stay informed, do your research, and don't be afraid to make changes to your portfolio. Remember, uncertainty can make the market volatile, but it also creates opportunity.
And speaking of opportunity, if I had to pick one company that I think could really benefit from this whole tariff thing, I'd go with Lamb Weston, ticker symbol LW. With the potential for higher demand for French fries if those Canadian imports get more expensive, I think they're in a great spot to gain market share and see some real growth. Now, as always, this isn't financial advice. Just my opinion. You got to do your own research and make your own decisions. But hey, you're here for a reason, right? You want to make smart investments, and that's what I'm here to help you do. So until next time, keep those portfolios diversified, stay informed, and happy investing.